Welcome. Today we're unpacking a problem that looks boring on paper, but quietly decides whether delivery is profitable or just busy work. Restaurant delivery fee reconciliation. Picture this. A customer places a $42 order. The POS shows $42 in sales, but the platform deposit that lands in the bank looks completely different. Why? Because commissions, card processing, promotions, refunds, ad spend, chargebacks, delivery charges, tax handling, and timing differences all sit between the order and the cash. Your kitchen is firing on all cylinders. Orders are flying in, but your bank account tells a completely different story. So the real question is not how much did we sell? It is how much did we actually keep, and can we prove it? In this story, we follow one delivery order from the guest's cart all the way into the restaurant's books, and we'll see how reconciliation turns a confusing payout into a powerful margin control system. Here's the hook. Restaurants often think they know what delivery costs because they know the advertised commission rate. Maybe the platform says 15%, maybe 20%, but that number is only the front door. Behind it is a whole hallway of deductions. Processing fees, sponsored listings, refunds, promotion redemptions, error charges, chargebacks, visibility fees, and even the labor needed to audit the mess can push your effective platform cost far above the headline rate. And in 2026, the FTC is actively investigating fee transparency while states completely rewrite their tax rules every quarter. That so-called 15% commission you signed up for? The real number can land between 30 and 40% of every single order. That's not a rounding error. That's your entire profit margin evaporating. Delivery is no longer just a side channel for extra exposure. For many restaurants, it is a primary sales channel, and if the restaurant cannot connect each order to its deductions and its deposit, delivery creates revenue while silently draining profit. You might think, I'll just match my POS to my bank deposit and call it a day. But that's exactly where everything falls apart, and the gaps are both systematic and designed to confuse. The POS records the sale on one day. The platform settles a batch on another day. The bank receives a net deposit combining many orders. The tax report may show platform collected tax separately, and every platform uses its own language. One calls it an Uber fee, another calls it an adjustment, another separates promotion redemptions from order adjustments. This is how small leaks hide in plain sight. A duplicated refund looks like a normal deduction. A missing promo reimbursement disappears inside a batch payout. A tax amount collected by the platform gets recorded incorrectly as the restaurant's liability. The problem is not just bookkeeping. It is a broken chain of evidence. And a broken chain of evidence means unrecovered cash, compliance exposure, and no power at the negotiating table. That leads us directly to the solution. Rebuild the chain, order by order. To cross this dangerous chasm, operators must build a rock-solid reconciliation bridge. The approach is simple in concept and disciplined in execution. You start with gross platform sales, then classify every reduction into standard buckets: commission, processing, delivery fees, ad spend, refunds, chargebacks, promotions, tax handling, payout adjustments. Each gets its own code every time across every platform. Then every platform order is matched to the POS sale, the platform statement, the payout batch, the bank deposit, the tax report, and finally the general ledger. If the item matches, it posts cleanly. If it does not match, it moves into an exception queue with an owner, a reason code, a deadline, and evidence attached. This is where reconciliation becomes operational control. It gives the restaurant a repeatable, defensible way to calculate the true effective platform cost. Not just accept whatever deposit arrives and hope the math works out. Here's what we discover when the bridge is built and the math gets done. The results are absolutely brutal, but incredibly revealing. A restaurant may find that the platform with the lowest advertised commission is not actually the cheapest once ads and refunds are included. It may discover that certain menu items lose money once packaging, food cost, commission, and promo funding are stacked together. It may recover missing credits because the evidence is finally organized and within dispute windows. It may catch duplicate refunds that would have otherwise gone unnoticed. And the tax picture finally clears. Which orders had tax collected by the marketplace, which refunds reverse tax, and which amounts belong in the restaurant's own liability account. The breakthrough is visibility. Delivery stops being one big black box deposit and becomes an order-level profit story. And once operators can see that story clearly, they can use it to make far better decisions about pricing, promotions, channel mix, and negotiation. Now for the real payoff. Once you have this reconciliation data, you have genuine negotiating power. You can walk into meetings with any platform and say, "Look, my effective commission is 34%, not 20, and here are 3 months of order-level proof." You can recover thousands in mischarged fees, dispute chargebacks with documented evidence, and redesign your menu to protect margins on delivery-specific items. You can also make smarter strategic decisions, platform-specific pricing, delivery-only bundles, or loyalty offers that gradually move your best repeat guests toward direct ordering where margins are far stronger. And in 2026, this matters more than ever. Regulators are scrutinizing online food delivery fee transparency. States and countries continue refining marketplace tax rules, and platforms are updating their contract language constantly. Restaurants that reconcile with discipline can review those clauses with real data in hand: who bears refunds, how promotions are funded, what tax language actually says, and how long the dispute window stays open. The data transforms you from a victim of the deposit to a strategic partner in the channel. This represents the fundamental paradigm shift. Delivery stops being a mysterious black box and becomes a transparent profit and loss line you can actively manage every single day. Here is the roadmap. In the first 30 days, gather the evidence: contracts, amendments, statements, POS exports, tax reports, payout files, bank records, fee schedules, refund support, and dispute deadlines. By 60 days, build the reconciliation matrix that connects each order to each payout and each general ledger entry, labeling every variance by root cause. By 90 days, automate high-volume matching so humans focus exclusively on the exceptions that require real judgment. The goal is not to eliminate finance review. The goal is to stop wasting human attention on rows that already match perfectly and redirect it toward disputes, tax questions, contract terms, and profitability decisions. That is the operating model shift. Delivery reconciliation moves from after-the-fact monthly cleanup to daily margin protection, monthly strategic insight, and long-term competitive leverage. So let's bring the story home. Delivery can absolutely be a powerful growth channel, but only if the restaurant understands what each order truly costs and what cash should actually arrive. The key is to match every platform order to the sale, the payout statement, the bank deposit, the tax report, and the general ledger. Standardize your fee categories. Validate your tax handling. Track every refund obsessively. Monitor your promotions. Review those platform contracts with experienced eyes. And automate the matching wherever volume makes manual work a liability. Done with discipline, reconciliation turns confusing platform statements into practical decisions about pricing, negotiation, compliance, and long-term channel strategy. The takeaway is simple. Don't just measure delivery sales, measure delivery profitability. Don't just accept the deposit, reconcile it, because the best time to stop a margin leak is before it becomes part of the business model. Like and subscribe for more helpful videos like this. Connect with Forks for the experienced accounting professionals your restaurant needs. Details in description below.